Index today has hit a fresh high, 1% up for Nifty. Broader market is looking strong, and Sensex also is now sitting comfortably above 21,000. So what has done the trick for us today? Because when we walked into trade, the global cues were pretty anemic, and there was nothing large or supportive for our markets. Manishi Chaudhary joins us. He represents PNB Paribas. Manishi, good morning. Thank you for joining us. So, Manishi, markets are moving from strength to strength. Are we on course to make a new high?
We are, of course, and but at the same time, I would point out that even though it may be a new high in terms of the absolute levels, it is not really a new high in terms of valuations. When we hit the 21,000 level earlier in 2010, or even before that in 2008, the valuations were at much higher levels. It's somewhere around 15 times, or earlier it was close to 17 to 18 times. So from that perspective, the valuations possibly around 14 to 14.5 times don't look that stretched. But having said that, there are significant divergence across sectors. So while you have the relatively attractive sectors which have performed well, the IT, consumer and pharma sectors, which are, appearing fully valued at this stage, you have domestic cyclicals which are still relatively inexpensive. But at the same time, the investor interest and the fundamental catalysts in those sectors are still absent. So the valuation divergence across sectors has possibly reached a peak at this point of time.
Manishi, so what happens from here onwards? You've got the RBI credit policy as well coming up next week. And if indeed we do see a repo hike of 25 basis points, do you think that could spoil the party, or is it something that the market is already priced in?
I think, I don't know whether it's priced in, but it's definitely in the realms of expectations. It now is very clear that the rate hiking cycle of the RBI would continue for some time, because the governor has clearly stated that his first set of interest is to curb inflation, and that sees no sign of subsiding. And in fact, you could even have an uptick in core inflation as a consequence of commodity prices spiking up and the rupee depreciating over the last 2 or 3 months. So, I think the 25 basis points of repo hike is pretty much what everyone is expecting right now. Whether that would lead to a correction in the market remains to be seen. But the one thing I would like to point out here is the rally that you've seen in India, it has not really come in isolation. It has come as a part and parcel of the global equity rally that we've seen. If you simply plot MSCI emerging markets, MSCI Asia, and MSCI India along on the same axis, they would show pretty much the same trend in course of last 2 months or so. It's a bit surprising, because I think the global risks have been kind of disregarded by the market. India has outperformed in this recent rally, and I think there are some political expectations also being factored in this most recent rally that we have seen.
Manishi, I guess the bigger question now is that what should investors do? Because even the markets have appreciated, Nifty sitting at a fresh high, there is very little participation. Is it too late to participate now? And for those who missed the bus, should they jump in now or wait for the next bus?
I am apprehensive of jumping in now, honestly, because I think this recent rally is, it's a bit premature. We are still in an environment of uncertainty as far as the earnings are concerned. Even though the first half of the earnings season in India has been slightly better than expected, with the IT services, private sector banks, and the large infrastructure and engineering companies coming out better than expected, I would think that when the PSU banks, the second-tier infrastructure companies, the materials sector, when they start reporting, we would see a downtick in the earnings growth. And honestly, in an environment of single-digit earnings growth for the market, it is difficult to foresee the market trading at these valuations that it is trading at. So I would definitely be apprehensive of jumping in at these levels.
But Manishi, if you had to name one banking stock wherein you could still buy and make money, which one would you recommend?
The ones that I would like to buy, let's say the HDFC Bank, the private banks which have a relatively low dependence on wholesale deposits. That in a sense explains the stance that we have. And so in that category, it would possibly be HDFC Bank or ICICI Bank. HDFC Bank is obviously a cleaner and a safer story, but at the same time, one would have to be prepared to pay those expensive valuations that it trades at.
Manishi, I'm with you when you say that valuations are looking slightly stretched, the fundamental turf is still looking slightly shaky. But as of now, we are staring at a lot of global liquidity, and liquidity could really make all the difference. So is one better off ignoring these strong liquidity signals which really could surprise us on the upside?
Well, liquidity it tends to be fickle, and it's very difficult to predict liquidity in the short term. What aided liquidity was the announcement from the US Fed in late September that tapering is being postponed. While that tapering announcement in late May had led to withdrawal of liquidity from global emerging market equities. And while tapering has been postponed, it is clear that it's not completely off the table. The U.S. government and the central bank are looking at the economic data, and they would obviously wait for an improvement, a sustainable improvement in the economic data. So our forecast is that tapering would possibly happen sometime in the first quarter of next year, maybe sometime around March or so. And, as a consequence, what we are seeing right now is really a short-term flow into the global equities, particularly the emerging market equities. So one would have to tread very nimbly and very carefully in this market if liquidity is the sole contributor to this equity performance.
Well, we're at a fresh 2013 high, clearly snapped the two-day fall that the market has been seeing. The advanced decline ratio is holding pretty steady at 23:2. You've got DLF, PNB, which are the top notchers. All major indexes have shot up anywhere between 1 to about 17%, and it is the BSE Realty Index which is indeed the top gainer. All components of the BSE Bankex as well, the 13 of the lot, they're actually holding out in the green. The Sensex as well has climbed above the 21,000 mark. You've got Bharti, which is a gainer. 29 out of 30 Sensex stocks are gaining, and Cipla perhaps is the only lone loser. All 13 lenders on BankX, they've gained anywhere between about 0.5% to about 2.7% apiece. The BSE BankX, in fact, has gained for a fifth day and is currently sitting at 1 month high. But it's no surprise to see the BSE Realty Index as the top gainer. Manishi, what's your sense? Each time the markets pick up, you typically see high beta come back into foray. Does it make sense to dabble into realty right now, or would you say steer clear?
No, I would clearly avoid that sector. That sector is suffering both from high leverage, particularly in some of the large frontline stocks, lack of cash generation, and also falling transaction volumes. So we are in our model portfolio also clearly underweight the property sector, not just in India, all across Asia. And, I would clearly not dabble into property at this point of time.
Manishi, just an observation here. Markets are moving up because of global liquidity. Foreigners are not interested in buying Indian PSU banks or cyclicals or, for that matter, real estate stocks. So who's buying into these stocks?
I'm trying to answer that question myself. So there are, I would suspect there are some ETF money which are clearly index linked. That would have flown in. So to that extent, pretty much all the stocks which are represented in the larger indices, they tend to move up when that happens. So I think there is a contribution from that sector as well. But apart from that, as far as the actively managed money is concerned, we're not really seeing major interest in the domestic cyclicals or the relatively risky sectors like the PSU banks, as we mentioned.
Right, Manishi, appreciate your time. Whereas all of us think that liquidity-driven markets are bad, well, liquidity has been the hallmark feature for at least Indian markets, because we've got $40 billion of inflows in the last 6 or 7 years. So, there's nothing wrong with liquidity. In any market, there is a buyer and the seller, and liquidity surely drives any financial market in the short term.